So in this podcast, we're going to be looking at analyzing financial information from the statement of profit or loss and also the statement of financial position and the relationship between a number of accounts. Now for the accounting joke of the day. How do dairy farmers do their taxes? They use a calculator. Now, a recap of last podcast, and we actually looked at the key accounting trends that you are going to highlight and monitor in your up and coming exam. Now, looking at this diagram, the key ones that you actually look at is firstly wages. Now, as you know, wages will actually account for 1/3 of the business total expenditure, and therefore it is a key expense to actually monitor. Now, if the wages are going up, you would hopefully see an increase in sales as a result of that. And if you don't, well, then you have a problem in that the extra staff that you put on may be unproductive and not actually contributing to the increase in revenue. Also on the statement of profit or loss is your cost of goods sold. Now, as you know, the cost of goods sold is an account and an expense which documents how much you actually are spending on the goods that you're actually selling. Now, from last podcast, as we know, you may actually have an increase in cost of goods sold, but you also need to look at whether that increase, say for example a 30% increase, has a corresponding increase in your sales. So if the sales increase is around the 30% mark, well then you've got no problems in terms of your cost of goods sold account. Say for example your cost of goods sold was 38% increase and your sales was a 30% increase, well then you've got one of two issues. One, the cost of your goods sold that you're actually buying is increased over time. You may need to look for a new supplier, or you're actually carrying too much stock, and that will actually be discussed in today's podcast. The other account that you're actually going to look at in terms of the statement of profit or loss is your change in net profit. Now, your change in net profit can be attributable to a number of things: a decrease in sales, or an increase in a number of expenses. And we are going to look at how to actually monitor and look for specific accounts that deal with the decrease in profit. Going on to the statement of financial position, and as we know, that deals with assets, liabilities, and owner's equity. An increase in inventories will give rise to cash flow problems, which we'll be discussing today. And the change in cash at bank. So the change in cash at bank, usually the one that you look at and monitor is a decrease, and that can be attributable to a number of things: decrease in net profit, okay, or an increase in accounts receivable, again, which we're going to look at in today's podcast. The change in total assets, if it's an increase, well, you need to look at how the business is actually paying for these assets. And lastly, advertising as well, and that comes from the statement of profit or loss. If your advertising is increasing, you would want to see an increase in sales of around 20%. If it is not increasing by that amount, then you can honestly say that the advertising campaign is not successful. Just a recap from last week's vodcast and looking at the key parts of an accounting financial statement. And in this case, we are looking at a statement of profit or loss, which looks at how much profit the business actually made for that financial period, and the number of key accounts, total sales income, and in this case, we are looking at net interest income, which is obviously looking at a bank's financial statement, whether their operating expenses are going up or down, and how much money they actually made in terms of profit for the year. And as you can see, this bank is obviously going backwards because in 2018 it had an $8 million profit, decreased to $6.7 million, and now sitting at $2.3 million. So you would not actually want to invest in this bank based on this declining trend. From the statement of financial position, which as we know looks at assets, liabilities, and owner's equity or shareholders' equity, the two main accounts from the asset point of view is your cash at bank, and this is showing a good result here in your cash at bank. It's gone from 20 to 30 million, and also the increase in property, plant, and equipment. Now, the increase in property, plant, and equipment is a good outcome for the business as it shows it's actually expanding. And in this case, it's gone from 1.2 million to 3.9 million, but we actually want to investigate how the organization is paying for this property, plant, and equipment. Is it coming out of the cash at bank account, or is it being financed through loans? And that's what you need to investigate for this exam. From a liabilities perspective, you actually want to look at the loans and the mortgages for a business. And as you can see here, the loans are going up, sorry. So it's gone from 501 million to 521, 563 to 591. And that is a very bad outcome for this organization. And you could probably say that the increase in those plant and equipment, which we discussed last slide, is primarily being paid for by these loans, which is a very bad outcome for any organization. The other important account that you actually want to look at in terms of shareholders' equity or owners' equity is whether they are actually retaining their profits and keeping it within the business. So in other words, the profits are actually being kept to expand the business as opposed to paying for day-to-day operations or being withdrawn by the owners itself. And as we can see here, the retained profits is going up, which is a good outcome for the business, and maybe they should start looking at using some of these profits to pay back the huge loans that this business actually has. Now, last podcast, I actually provided you with a structure for your report that you need to write on your exam. So last week we started looking at the trends. Now we're looking at point number 3 here. What are the relationships caused by these trends? So this is a very important part of the role of an accountant, and also where most of your marks for this question is going to lie. What are the key accounting relationships between accounts within the statement of profit or loss and also the statement of financial position? Now, the ones we are going to concentrate on and the ones which you need to know for the exams are the following. The increasing wages, whether that's not comparable to an increasing in sales, whether your advertising campaign is causing a 20% increase in the rise of sales, so you need to look at that relationship between those two accounts, whether there's a cash at bank issue, and whether that cash at bank issue, so in other words, a decrease in cash at bank, is because there is a lack of cash flow from increase in credit sales, and which the business has not received the payment from accounts receivable. So as you know, credit sales are sales which are made on credit, and therefore some of the accounts receivable may not have actually paid off their account yet. So you're looking at whether this account in the statement of financial position is increasing, and that could actually give rise to a lack of cash flow and a decrease in the cash at bank account. Whether the growth of the business assets is due to the equity growth rate or an increase in long-term liabilities, for example, loans or mortgages. So we're going to look at the relationship between loans and mortgages and the increase in total assets of the business. The second large relationship we're going to look at is whether the business is holding too much stock, which may cause cash flow and profitability issues. So as you know, a cash flow issue is not having enough cash at bank in the asset accounts, and a profitability issue is whether the cost of goods sold has increased and therefore eroding the profits of the sales of the business. What stock is an inventory, or inventory is an asset in which you'll actually see in the statement of financial position, and carrying too much inventories usually will give rise to a decrease in cash at bank. So we are going to look at the relationship between the inventory or the stock account in the asset statement of financial position and whether that is giving rise to a decrease in cash at bank. The last relationship we are going to look at is whether there is a drop in net profit and whether there are increases in specific expenses or a drop in sales causing the drop in net profit. So from all of these accounting relationships, you can see an accounting relationship can be determined or defined as a trend which is then causing a ripple effect through a number of financial accounts, whether they are in the statement of profit or loss or the statement of financial position. Now we are actually going to go through these relationships one at a time, and I'm going to provide to you on the slides extracts from either the statement of profit or loss or the statement of financial position. And the first one we are going to look at is the relationship between wages and also sales. Now, as you can see here, wages or salaries, they could either be both, are found in the statement of profit or loss because they are actually expenses. And sales, and in particular total sales, is again found in the statement of profit or loss because it is a revenue account. And we can actually see here by comparing 2020 to 2021, there has been an increase in sales of approximately $9,000, which is a good outcome for the business. However, we can actually see here that the total wages, so in other words, combining the wages and salaries together, has increased from 166,000 to 188,000. Now, is that really a good outcome for the business and a good use of money? And that is what we need to examine the relationship between now. Now, as you can see here, and I've written here a little extract or a couple of sentences which you can actually use within your exam to define firstly the issue and also the relationship. Now, the issue here that the business has spent an extra $20,000 on wages and salaries for an extra $9,000 increase in sales. Now, this shows that the employees are therefore unproductive and need to be performance managed. So, in other words, these increase in sales of approximately $20,000 should have given rise to more than just a $9,000 increase in sales. And therefore that difference of $11,000 has eroded the net profit of this business, which is a bad outcome for it. So what do I mean by performance managed? So that basically means that you look at the productivity of all of your employees of this business, and anyone who is showing to be unproductive, so therefore may not be contributing enough to the sales budget or might not actually be meeting targets in terms of the sales, is a recommendation to be performance managed, which means you're actually monitoring their performance, and if it doesn't actually improve, will give rise to termination of that employee. So again, if this relationship arises in the exam, this is the type of paragraph that you actually need to provide. So I'd be using this structure in this podcast in your up and coming exam. The second relationship which we are going to be looking at is the relationship between advertising and total sales. Now, advertising, as we know, is the promotion of the business in order to generate more sales. And being an expense, advertising will be found in the statement of profit or loss. And again, with sales or total sales being a revenue, will be found in the statement of profit or loss. Now, in this case here, we have seen an increase of advertising from $10,000 to $15,000. So in other words, a 5% increase in sales, advertising, sorry. So what we got to analyze as an accountant is whether that $5,000 increase in advertising has given rise to a 20% increase in sales, because that is the rule of thumb that all financial accountants look at to see whether an advertising campaign is successful or not. So what you will write in your exam, if this is a relationship that has actually occurred or a trend that has actually occurred, you would say that advertising has increased by $5,000. That is the trend, with a corresponding increase in sales of $9,000 as well. And again, the increase in the sales is a trend as well. So you always start your answer with the trend. And the next is whether the advertising campaign is deemed to be successful. So in other words, we are looking for the relationship between the increase in advertising has given rise to a comfortable increase in total sales. To have an effective advertising, sales will have to have increased by 20%. Now, in your exam, you will have some various analysis on the right-hand side here, which will compute all of the increases or decreases in accounts between the previous year and to the current year. But I've actually done that for you. Now, along with the issues of increase in wages, which we'll discuss later, the advertising has not returned the required increase in sales. Now, the 9,000 increase has given rise to a 0.23% increase in sales from the previous year, which is well below the target of 20%. So therefore, that creates an issue in terms of profitability and also the effective use of cash in the form of the increase in the advertising campaign. The next relationship that we are going to be looking at, and this involves 3 accounts. So this one is a very important relationship to look at, and it is looking at the cash flow of the actual business in terms of cash being generated through credit sales. So the first account that we're actually going to be looking at is credit sales. Now, credit sales, as I said previously, is sales generated through accounts receivable. And accounts receivable are people who owe us money but has not actually paid their account yet. So we have seen here that there has been an increase in credit sales of $139,000, which is a good result for the business. Okay, but accounts receivable has also increased by $21,000 as well. So we need to look at is whether this increase in $21,000 is creating a cash flow issue for the business. Now, what I mean by a cash flow issue is these accounts receivable are not paying their accounts on time, and therefore we do not have enough cash to pay for our day-to-day operational expenses, but also payment for any expansion in terms of increasing property, plant, and equipment. So the business will have to monitor the credit policy so to look at whether the outstanding debts hopefully will not actually turn into a bad debt. Now, I've provided a little extract here. In this case, the increase in credit sales fortunately has not given rise to an increase in bad debts because it's actually gone down from 5,000 to 4,700. So therefore, their credit policy is doing well. However, because we got such high accounts receivable controls, and that has increased by $21,000, we can actually see here that our cash at bank has decreased by approximately $100,000. Now, as you can see here, that $100,000 is made up of the increase in our accounts receivable of $21,000 for the year. Okay, so we actually need to try and get this accounts receivable at the end of every month as low as possible. And that basically means that we are generating more cash for the business, and therefore we'll see a corresponding increase in the cash at bank. So the next relationship we are going to be looking at is a relationship between how we're actually paying for our property, plant, and equipment, and the 3 accounts that are in question are total assets or total non-current assets, okay, loans and mortgages, and also our bank account. Now, looking at the extracts of the statement of financial position, which looks at total assets and assets, you can actually see here that our total non-current assets have actually increased by $441,000, which is a good outcome for the business, which means that the business is growing and expanding. However, what we need to look at is how did they actually pay for this increase in $441,000? Now, the first thing that we actually look at is our cash at bank account. Now, our cash at bank account has decreased by $100,000. And from the last slide, that decrease is primarily due to our accounts receivable not paying their bills on time, which leads to a cash flow issue. So because this has gone down, we need to visit our non-current liabilities, and they could either be loans or mortgages. And as you can see here, our loans and mortgages, in particular the loan, has remained the same, and our mortgage is actually going down. And now that is a very, very good sign for the business. if we were having cash flow problems, immense cash flow problems, you would have seen that this mortgage has gone up. So you can safely say that this 441 increase in our assets is primarily due to our profits, which are coming from our equity account and also from our cash at bank account. So I'm just going to read this here. Total plant and equipment has increased by $441,000, and you need to analyze how did the business pay for the property, plant and equipment. If this is the case, the loans are decreasing, which is a positive outcome. Since the liabilities are decreasing, the business is using the internal profits, in other words, coming from the total equity, and also its cash at bank account to purchase these assets, and the cash at bank account has decreased by $100,000. So this is a good outcome for the business, and that is the issue that you have to analyze. Now, if you're looking on the flip side of this, if this was increasing and this was decreasing as well, and this was increasing, the mortgages was increasing, well then that is a very bad situation for the actual business. And that is relationship between the loans, in other words the liabilities, the assets, and the bank account. Now, another relationship which you need to look at is our inventory control account, or our stock in our statement of financial position. Now, inventories is an asset, and it's all the stock that is being stored in the warehouse waiting to actually be sold by the business. Now, what you need to look at is whether this account is increasing. Now, it is good that we're actually holding stock and the assets are growing. However, you don't want to actually get it out of control. So in other words, a massive increase, which is what has actually happened here. Your inventory controls has increased by 190,000. And we've had a corresponding decline in our bank account of 100,000. Now, as we said in the last two slides, the decrease in our bank account is due to one reason: our accounts receivable not paying on time. We've used the cash to expand our business to purchase assets, and also we have used our money to buy excess stock as well. Okay, now the excess stock is given rise to a decrease in our cash flow for the business, because we can't actually sell that stock until it is out of the warehouse. So it is just sitting there consuming or eroding the cash flow of the business, and therefore contributing to the erosion of the profits as well. So the cash at bank, just to summarize again, you're looking at the relationship between the movement in this account between your accounts receivable, your inventories, and also whether that account is being used to pay for the expansion of the business. So very key relationships there. Now, the next relationship we are actually going to look at is the net profit. Now, as we can see in this business here, this is the previous year, our net profit has gone from 23,000 to 29,000, which is a good outcome for the business. However, it could have been improved had we actually had control over a number of key expenses. Now, when you're looking for a decrease in profit, you're looking for reasons why this profit has gone down. And in particular, you're looking for key accounts. So the key accounts that have obviously eroded or decreased this good outcome for the business is this one here with the insurance, and it's actually gone up by $11,000. And that is something that needs to be investigated. Another one which you'd obviously look at is our office expenses, which has gone up from $9,000. And so therefore, they are the two major accounts that have contributed to the erosion of the net profit for this business. Still a good outcome that we've actually increased our profits, but it could have been better if we actually looked at and monitored those two accounts, which I've just explained there. So in summary, the business needs to monitor these expenses as it's eroded the profits of the business. So therefore, that has again given rise to a cash flow issue. So this ends the vodcast on financial analysis and the relationship between a number of key accounts in the statement of profit and loss, or the statement of financial position. Our next vodcast is going to be looking at how to analyze key financial indicators for the business. Calculator.